Everyone. My name is Kim Heffernan, and I am a financial advisor with Northwest Financial Advisors. We are a wholly owned subsidiary of Northwest Federal Credit Union, and we specialize in comprehensive financial planning and investment management services. Today we're going to focus on some retirement savings and planning, and specifically the differences between Roth and traditional money and how they can be utilized in your long-term financial plan. So some housekeeping before we get started. The information contained in this presentation is for educational purposes only. It's not intended to be a substitute for specific individualized advice. We do recommend that you consult with a financial advisor for guidance specific to your unique situation. With that, we'll go ahead and get started. So when we're thinking about financial planning and the financial planning process, our main focus is really on putting a strategy together to help you figure out what your financial goals are and how we are going to save for them. Right? We all have different goals throughout our lives that we want to accomplish, whether we kind of know what they are right now or not. An ultimate goal for most is going to be some sort of retirement period, right? To save enough money over our career so that one day we don't have to work anymore. We can live off of that retirement savings, maintain our quality of life. We have other goals as well. They may be more shorter term. So we want to manage saving for all of them and really determine how much we will need to save. So here we have the median prices in the DC metro area for each of these common goals. And what we're thinking here is that as the financial need gets larger, ideally so does the amount of time that we have to save for that goal. Because of this, though, it can be easier to focus on our shorter term goals first. They may be smaller, more simple to address. We feel that sense of accomplishment. But if we do divert our savings all to one thing or fewer things and kind of disregard the others, ultimately that's going to have an effect on our larger goals like retirement. So what we want to do from a planning perspective is address the most complex needs first, and then prioritize accordingly after that. In most situations, that is going to mean that retirement is number one. Anything that we can do to make that goal a little bit easier to reach, and looking at college savings, a new house, a new car, really fitting everything together based on you. So once we've considered what those goals might be and what's important to you, we want to plan to get there, right? Primarily, we're going to do that by setting aside money into savings and into investment accounts to build wealth. In kind of the financial planning world or the financial world itself, there are two different types of assets. When we're thinking about money, we can think about it as qualified retirement savings or non-retirement savings. So today we're going to focus on this left-hand side of this chart here, qualified retirement money. The differences between the two main categories here of traditional and Roth, and all the different types of accounts that can fall into those two categories. So starting off with traditional money is pre-tax. This means that if you make a contribution into a traditional account, you are going to receive an income tax deduction for making that contribution, helping you to pay less taxes now. Because of this deduction, the account is tax deferred, meaning that in retirement, when you go to pull out the money or take a distribution, it is fully taxed to you at your future income tax bracket. If you put in $100 today from your payroll deductions, that $100 grows to $150 over the next however many years. You pull out the $150 and that entire amount is taxable income to you like a paycheck. So less taxes now, pay taxes in the future, right? Because this is designed to be money that is set aside for retirement, if you do take that distribution prior to age 59 and a half, which is kind of that IRS's magic number, there are tax penalties. There are a few exceptions, but most of the time it is going to be fully taxable to you at your income tax bracket, as usual. But then it's also assessed an additional 10% penalty because you didn't wait until that certain age. So if we're in kind of the 22% tax bracket, we owe that, 6% Virginia, 5.75% Virginia, another 10% federal on top of that, as a way to try to deter you from accessing it prior to that age, right? Lastly here, we have that all traditional assets are subject to required minimum distributions. So that is either going to be at age 72, 73, or 75, as it stands now, depending on your year of birth. You're required to start taking distributions on this traditional money and paying those taxes. So that's whether you need that income or not. If you're already taking money out as an income source and you meet that minimum, then you don't have to do it again. But if you're not, you do have to take that minimum out on an annual basis. What they do is look at the prior year's balance at the end of the year, so on 12/31, and use the RMD tables from the IRS to calculate that minimum that you would have to take out. Alternatively, we have Roth money, right? Roth money is after tax, whereas traditional is pre-tax, Roth money is after tax. If you make a contribution into your Roth account, you do not receive any tax help. Right now, there's no income tax deduction. But when you go to pull that money out of the Roth in retirement, it is tax-free. So if your $100 contribution grows to $150, that whole $150 that you take out is tax-free to you. So we're potentially paying more in taxes now, but the alternative is to pay none or less in the future. So the same as traditional money, this is designed to be set aside for retirement. So if you take that distribution prior to age 59 and a half, again, there is a penalty. Again, there are a few exceptions, like on the traditional side, but most of the time, your contributions will come back to you tax-free because you didn't get any tax benefit for making that contribution. But any growth or earnings that you have on that money is subject to income taxes and the 10% penalty. So if we're thinking about taking distributions or kind of how that fits in, that's where we want to keep aware of what that looks like. Roth money then is not subject to the required minimum distributions like traditional money is. It's not generating any tax revenue, so you can keep that money in there if you don't need it. So once we've considered the two categories, traditional and Roth, we can move down to the account level of how do we access traditional and Roth savings. The first way, and usually the most common, is your employer retirement plan. So what is offered to you through work, whether that's a 401k, 403b, 457b, the TSP, or something like that. All plans are going to offer a traditional option, and then some employers may also offer a Roth option as well within the plan. It's becoming more and more common, especially with larger companies, the federal government's TSP. They're offering it more often now. So as an employee, you're eligible to contribute up to $23,000 into your employer plan for the 2024 tax year, and this is just your contribution, so it does not include any of the matching. If you're over the age of 50, an additional catch-up is available. You're allowed another $7,500 into the plan for a total of $30,500 for 2024. Again, just your contributions. So you have the option then to make traditional contributions. If Roth is available, they can go to the Roth side, or they can be split between the two to whatever degree makes sense for you. You don't have any limitations up to that $23,000 or $30,500 limit. If your employer offers a matching, their contributions are going to go into the traditional side, but that's regardless of where yours go. You can do all Roth and you'll get your matching in traditional, or you can do a little bit of both. Secondary to those employer plans are retirement accounts that are separate from work. So that's where we see traditional IRAs and Roth IRAs. So these accounts allow you to set aside retirement savings in addition to what you're doing at work. They have rules around them, of course, but it's a way to put more than that $23,000 or that $30,500 limit into retirement plans if you were wanting to do so, if it made sense to do so. So with IRAs, we have lower contribution allowances than in those workplace plans, and also income limitations to be able to use them. So as long as you qualify, you as an individual can contribute up to $7,000 per year into a traditional IRA, a Roth IRA, or split between the two. That is not a per IRA limit, it's your IRAs as a whole. If you're over the age of 50, you get an additional $1,000 catch-up provision, so you can do up to $8,000. So depending on your tax filing status, on this slide here we have the household income levels that you would need to be in to be able to use IRAs. So depending on what that looks like, we can kind of put a strategy together from there if it makes sense to utilize accounts separate from your workplace plan. So once we have an understanding of what is available to us through work or separate from work, we want to take that step of deciding what makes sense for us. What should we take advantage of going forward? For any retirement savings, we want to start with our workplace plan first, especially if the employer offers a match. These plans are generally lower cost. You can contribute more to them because they have higher limits. And if your work is willing to give you some extra incentive through a matching program, you always want to take that, right? Second to that, then we're going to look at if we're eligible to use IRAs, if we have cash that we're looking to put towards retirement in addition to our workplace plan, should we go that route then? There are some situations where maybe an employer doesn't offer a plan, right? If that's the case, you do have more flexibility in using those IRAs. But you also might have more flexibility if you are self-employed or like a 1099 contractor. You have a whole lineup of other options to essentially create your own plan. It's not the end-all be-all if your employer doesn't offer a retirement plan for you. Then we want to look at your tax situation. Do we generally owe a lot? Would it be beneficial to utilize traditional retirement savings to maximize your income tax deduction? Or maybe we're okay with paying a little bit more right now to be able to use that Roth savings and have tax-free availability in the future. The other side of that is that we want to look at what our tax situation could potentially be in the future, right? Are we going to be receiving pensions? Are we going to be receiving Social Security, inheritance that is going to be taxable? What does our potential future situation look like as well that we might want to attempt to offset right now? Lastly, then, we're looking at what is in these accounts, right? We want to look at the types of investments, what are held in these retirement accounts, and how is our money working for us. So getting back to that third point there of looking at traditional versus Roth, as we move through different stages of life, different income levels over our career, this choice is going to change or can change, right? So basically each year you have the option to decide what you want to contribute to. You are not locked into doing only traditional or only Roth forever. Considering, does a tax deduction now mean more to us than tax-free income in the future? If we're in a lower income tax bracket right now, probably not, right? If we are at the beginning of our career and we can kind of assume that we're in a lower income tax bracket than we might be in 10, 15, 20 years from now, then maybe we can take advantage of that and utilize Roth savings right now. If we're approaching the next income tax bracket, or we've gotten married or divorced and now we're in a new tax situation, then maybe not, right? It's something that can be revisited every year and really evaluating which one makes sense for your situation. Maybe we're anticipating a big raise or a bonus, so we want to divert to traditional, or we just got a new mortgage at the rates that they are right now, and I'm going to be able to itemize just based off of my mortgage interest. So I have a bigger deduction and I can use Roth right now. There's all these different factors that go into that decision process. Generally, the theme is going to be that we want to start off with Roth early in our career, and then as we move through different ages and different income situations, up to our highest income earning years, doing either some of traditional and some of Roth, or all traditional, kind of depending what all those different things look like. So I mentioned it briefly a few slides ago, but one of the most important pieces of the plan, once it has been determined which type of account we're going to use, is then what we're going to hold in the account. So we want to figure out, how do we position so they're working for us? And that really begins with a conversation around risk and our investment objectives. So we want to be holding the appropriate type of money in there, right? We want to make sure that that aligns with our goals and our plan. So are we striving for growth, which would mean taking on more risk for a potentially higher return? We want to be more moderate, kind of middle of the road, some growth, but also some conservation to not take as much risk? Or are we really wanting to be conservative with these assets? To be very little growth, but really more trying to preserve the value instead of taking on the risk. So depending on that risk preference, that objective is going to determine what we should hold in that account, what we should be invested in, and to what degree, right? So should we have equities? Do we want stocks? That can be U.S. companies, international companies, specific sectors of the economy like financial companies or technology companies. Do we want to have fixed income, which is the bond markets? So we're looking at government bonds, municipal bonds, private company bonds, alternatives like real estate or commodities, hedge funds, crypto, things like that, or cash. And so depending on our timeline for investment, that can also help to determine the amount of risk we might take on. If we're looking out long term towards retirement, say, we might consider being higher risk versus a more moderate approach if we're getting closer to retirement or in retirement. Above all else, we just want to make sure that this money is working for us efficiently and helping us reach our goals. So we want to figure out what that means in relation to our plan. But we're doing all this work to set aside the money and make the contributions. We want to make sure that what it's doing in that account is helping us as well. As with most things in the financial services industry, it's not always cut and dry, right? So now we're going to go through a few strategies that could be implemented with retirement savings in addition to kind of the normal channels that we just went through. So the first that we're going to start with is the backdoor Roth. So if you are over the income limitations to make a normal Roth IRA contribution, as everything stands right now in terms of the IRS and the laws, you might be able to do what's called a backdoor Roth contribution. So as long as you don't have any other traditional IRAs, you can open one up and make what's called a non-deductible contribution, meaning you put the money into the traditional IRA, but you do not take the income tax deduction. You immediately take the distribution from the traditional IRA and convert it into a Roth IRA. We're taking the $7,000 or $8,000, we're putting it in a non-deductible traditional IRA, and taking that entire amount, $7,000 or $8,000, and rolling it over or converting it backdoor into a Roth, allowing the money to then grow within the Roth IRA. We're taking that extra step, the backdoor, through the traditional to get it into the Roth, and this is allowed no matter how much money you make. So if you have a traditional IRA, there is a pro rata rule that brings along a number of other things to the process, but it still works, it just works a little bit differently. So if ultimately the goal is to get money into a Roth IRA, we You can take that extra step, do the conversion to get the backdoor money in there. The second is Roth conversions, and this is a big one. So different than backdoor contributions, this is a Roth conversion. So if you have traditional 401k or traditional IRA money, you can take it from the account and convert it into Roth money. So we're taking a distribution from the traditional account right now, paying taxes on it, and then converting that amount into the Roth IRA to then continue its growth and investment in the Roth tax-free. So this is different than the backdoor Roth, where you're making a new contribution with a new $7,000 or $8,000. This is with existing 401k or IRA money that you've already made the contribution, you've got the deduction for it, and it's been sitting in that account from an old employer, or when you made an IRA contribution when you were just starting out work, or whatever that may look like. So if you're, let's just say you're 60 years old, you have a $500,000 in a traditional IRA. Within the traditional IRA, it remains invested, it grows until you reach that required minimum distribution age or until you need it. So it continues the growth and continues the tax-deferred qualification. Instead, if you take some of it now, say $50,000, $100,000, you pay taxes on that money, convert it into the Roth IRA, then that $50,000 or $100,000 is now growing in the Roth tax-free, and we only have $400,000 in the traditional that is going to be subject to those taxable distributions. So the benefit is allowing you to pay taxes on lower traditional IRA amounts and having those assets grow and reinvest and earn interest in Roth rather than traditional. So generally, we're going to look at kind of 4 considerations when we're thinking about if a Roth conversion makes sense. The first is going to be your tax rate, as always, both now and in retirement. If we expect our tax rate to be higher in the future, we might want to convert and pay taxes now, right? Generally, we expect to be in a lower income tax bracket in retirement, and that could be the case. But if we assume that tax rates are going to increase in the future, and then we're looking at a pension and Social Security and required minimum distributions, those could bring us close to the same income situation we're in right now, right? We might not actually be in a lower income tax bracket. We want to weigh those options and really see what that could look like, assuming whatever you want to assume about the tax brackets, right? But required minimum distributions, depending on your traditional assets, could be significant. So we just want to keep that in the back of our minds. If we're concerned about estate planning and our beneficiaries, Roth conversions could help to reduce the taxes that our beneficiaries would have to pay. Roth is tax-free money, right? So you're not passing money on to your beneficiaries that they will have to pay taxes on. So it's kind of considering, do I want to eat the taxes or do I want to pass it on to them? Some people, that's a big part of their estate planning process. Some people haven't considered it, so kind of looking at what that looks like. A big piece of the Roth conversions is going to be whether or not you have funds available outside of your retirement account. So when we're considering the conversions, they are most beneficial if you do. If you have those funds that are available outside of your retirement account to pay the tax bill. So when you do the conversion, that distribution from the traditional is taxable, right? It's going to get added to your income for that tax year. You have the option to withhold taxes on that distribution to help pay that tax bill, but it is more beneficial if you don't. So if you take out, we'll say $100,000, withhold 20%, then only $80,000 of that is actually going to make it to the Roth IRA. Whereas if we can pay the tax bill from cash reserves, a CD that came due, non-retirement account, then that entire $100,000 can make it into the Roth IRA and can grow tax-free, ultimately making it more worth it or more providing you more tax savings kind of over the life of your plan. Lastly, the fourth category, or the fourth thing that we're considering down here, is that the more time we have for investment, or the more time we have in our plan, basically saying how long you plan to live, right? The more time we have to recoup the taxes that were paid as a result of the conversion. So the longer we have it able to reinvest in Roth, the more benefit we receive from paying that tax bill, right? So one situation where we would really consider this from a planning standpoint is if you're in kind of a in-between time frame. If we have retired and have enough income but have not taken Social Security yet and have not reached RMD age yet, we might have kind of this window here to really take advantage of potentially converting some money. There's, of course, many situations where it makes sense, but that is one that we see most often. Because even if you aren't retired at any time, if we want to pay the taxes, we can take advantage of the conversions. We just want to consider the degree that we're doing so. Next, we have after-tax retirement plans. So in addition to the traditional and the Roth employer plans, some companies also offer kind of this third category as a benefit called an after-tax plan. If you're a federal agency employee, this is the VIP, or the voluntary investment plan, or the voluntary contribution plan if you are civil service. So these accounts are essentially a hybrid between traditional money and Roth money, and that is separate from the employer 401k and its contribution limits. So it's separate from that $23,000 or $30,500 limit. Money that you put in there is after tax, Roth money. And then the earnings grow tax deferred, like traditional money. So if you contribute $100, you don't get a deduction, but it grows to $150 at retirement. You have $100 tax-free and $50 taxable. So when you leave the company or retire, you get to take prorated distributions. Or with the VIP plan, the contribution portion can be rolled into a Roth IRA. The earnings portion can be rolled into traditional IRA without having to deal with those IRA income limitations. The VIP and the voluntary contribution also have a few special provisions if those plans apply to you that involve kind of making retroactive contributions. So that is something we can assist with as well if you fall under that plan. All right, last but not least, we focused on retirement money today, but that is only one piece of your personal financial plan. It's really only one goal, right? So what we want to do, we're here to look at all of these different aspects of your financial picture and really help to put that plan together to help you reach your goals. It's always a good time to check in on our finances. We believe it's better to have a plan that needs an adjustment than to have no plan or no direction at all. And we want to use the foundation of your life for that plan rather than like an investment account or just one specific goal, so that we can help to more effectively make decisions and help you to be successful in the long term. Thank you for joining me today. Northwest Financial Advisors, we offer complimentary consultations to anyone that is interested. We really sit down and go through a lot of this information, right? We want to take a look at your current picture. What is important to you? What do you think is on the horizon? And are there any adjustments or recommendations that we can make that will ultimately help you in the long term? It also involves discussing how to have an ongoing relationship with us if that is a suitable option for you. So this can be done virtually. Our main office is in Herndon. We also work out of the branches of the credit union. When the webinar closes out, you will receive a survey that can be filled out if you would like to be contacted for a consultation. This is also my direct line, direct email, and website if that is something you're interested in doing. So thank you again for joining today, and have a good evening.